Hi, my name is Steve Zeiger. Over the past several years, we've been asked to educate members of NAPAC, the National Association of Estate Planners and Counsels, STEP, the Society of Trust and Estate Practitioners, over 30 local estate planning councils, over 10 FPAs, the Practicing Law Institute, the CFA Society, and we've been speaking about the fiduciary era for life insurance. We've had so many requests for the presentation, we decided to put together an educational video so you can have a copy of the presentation and you can have our verbiage in the background. And now's actually the perfect time to educate fiduciaries on the proper decision support material for life insurance, because on October 20th, 2022, the New York State Court of Appeals constitutionally affirmed Regulation 187, the nation's first client's best interest regulation. A little bit of housekeeping before we begin. If you have a question, you can email me. My telephone number is on the screen. If you'd like a copy of our Trust and Estates article, simply send me an email. We're happy to send it to you. And if you'd like a research report at no cost, again, simply email us or call me on my phone. It doesn't mean we're doing business together. If you have a request, it simply means you'd like to learn more. So let's take a look at this illustration. In the left side, you can see that the planned premium is $181,000 a year. And then you'll see this blue section that says the end of year guaranteed assumptions at 2%. And on the right side, you'll see the end of year non-guaranteed assumptions at 4.95%. And what we're going to do is we're going to look at years 24 and 25. And we're going to do the only math that you can do in a life insurance illustration. First, we're going to subtract this year's cash value, $1.828 million, from last year's cash value, $1.76 million, and we see that there's a difference of $51,934. So we had a gain, an actual gain of $51,934. And then we want to look at what was our expected gain. So our expected gain is $1.828 million times the 4.95%. We expected a gain of $90,516. So the only math that's left to do is to subtract those two numbers. So if we expected $90,000 and we only received $51,000, the only conclusion we can make is that we had an expected cost of $38,582. So just write these numbers down really quick. 1.828 million cash value, expected gain of $90,000 at 4.95%, an expected cost of $38,000. On the next slide, we request from the insurance company the detailed expense and the detailed performance for this policy. So we see the same $181,000 premium, and now we know that every year there's a premium charge of $32,588. There's an admin charge that starts at $33,000 and rises to $49,000 by age 30. And then there's a column, how much is credited. Let's look at the 25th year, the same year that we were looking at on the previous slide. The cash value is $1.828 million, and the insurance company credited $348,000. Well, we determined that 1.8 million times 4.95% was $90,000. So therefore, a $348,000 credit is a 19% rate of return. Now, I'm not here to discuss whether the insurance company can credit 19%, and I'm not here to discuss whether they can't credit 19%. I'm simply here to say that the insured, the policy owner, the grantor, the fiduciary advisor, they all think this is a conservative product run at 4.95%, when in actuality, it's an aggressive product in this year run at 19%. And just so you see that I'm not picking one strange year out of the 30 years, let's look at the 30th year. When the cash value is $2.03 million, the amount credited is $580,000. Quick math, a 25% rate of return. Now, I know what you're thinking. Steve, this is probably the only misleading illustration out there. So I'll show you another one. In this example, in the red box, you can see that the illustration is based on a conservative 5% rate of return. And what we've done is we've gone to the 11th year when the cash value is $116,776. Then we've requested from the insurance company an additional report. We want to see what's the cost of insurance charge, what is the policy expense, what is the premium load, and what is the interest credit. And you can see in the red box, the interest credited was $16,556. Well, quick math shows that's not 5%. It's actually 14%. And again, I'm not here to discuss whether they can pay a 14% rate of return or whether they can't pay a 14% rate of return. I am here to say that everyone thinks this is a conservative illustration when it's actually, it needs to do an aggressive return in order to illustrate at the 5%.